Okay, folks, we are live. Live. Just got to go into the members area, get our quotes for this evening from our esteemed members. And yes, I keep getting inquiries. Uh, I can't sign up. Correct. You can't sign up. We're having issues with the software. Membership is closed right now till resolved. And we have Jeff with BYON, a couple of symbols going on here. We have the futures market, which is just reopened, and we are getting ready for a heyday of a Friday. So let's get to it. Let's talk about what needs to be spoken about, and that is the Federal Reserve's balance sheet and where to with this market. Where are we going? So what we like to do on Thursday nights is prepare, not for Friday, but for next week. So we're going to be going over the weekly charts to take a look at what's outperforming. Where might we want to put our money going into next week? Are we looking to go short? Are we looking to get long? Is it a commodities market? Is it a small caps market? Is it a large caps market? It's a very complex market right now, and those that were leaders are lagging a bit. Case in point, SMCI and NVIDIA. The markets were up today, and they were down. Relative strength favored small caps and the Dow Jones industrial names. The Magnificent Seven names, not so much. Maybe that'll change in the coming days, but right now, odds favor small caps and they favor the Dow Jones names. And we'll go over the reasons why in a moment. So let's walk through what we like to look at in terms of trying to identify whether the markets are going to go up. Because, yes, I'm a technician, and you may be saying, why don't you just look at a chart? It's not that simple. Charts are random. They are random. There is a rhyme to them. The higher level you go, the more rhyme there is. A monthly chart is going to be a smoothing mechanism relative to a daily chart. A daily chart is going to be more of a smoothing mechanism relative to a 15-minute chart. So what helps our probabilities and our edge over our competition, which is by and large computers, is understanding the events that are coming down the road that could either A, halt the market rally and send it in a trajectory that may not be favorable for bulls. And we also look for catalysts. What is the market looking at in terms of favorability for being bullish in the equity markets? That's what we're meeting about tonight. Now, what we're going to first go and do is I'm going to take you back to the Fed meeting from last week. What did Jay Powell say that he was going to do? He was going to stop. Remember, there was a sell-off after that presser. I was like, people are missing something here. It wasn't that hawkish. It was actually dovish. He spoke hawkish, but his actions were set to be dovish. What was that? It was the slowing of the selling of treasuries off of the Federal Reserve's balance sheet. And he followed through this week. So it wasn't just chatter. He took action. So let's go down memory road, and we'll talk about the whys of why this is important. This is a 5-year chart. Here is COVID, if you could believe, all the way back here now. And the Federal Reserve ballooned their balance sheet by over double, 100% more. Now we have deflated the balance sheet somewhat, but we are still elevated relative to where we were back during the pandemic. Now you see this little blip up high here. That was the regional bank crisis of 2023. And you can see that we've dropped down quite a bit here. So the Fed met last week. He gave his presser, no rate increase. We knew that already. That was no great shock. The question was, will he follow through on declining or reducing the rate of the reduction of the Federal Reserve's balance sheet? Let's go to last week. This is as of yesterday, released today. Last week was 7 trillion 300 362 billion, 474 million. They've reduced it basically by a rounding error of a couple of $1 billion. This is nothing. This is nothing. Might as well have done nothing last week in terms of the reduction of the Federal Reserve's balance sheet. How does this impact the markets? Why is this favorable? Well, if you're a bond trader and you know that the Federal Reserve is going to sell $37 billion per month less into the Treasury market, what does that do for the value of bonds? Well, it lifts them up, lifts up those treasuries. What happens to yields? Yields go down. So as long as the Federal Reserve does this stealth easing, then equities can continue up higher, even though they're not cutting rates. So understand why we go over this every Thursday. We never miss this. This is important. What we're beginning to see here is the beginning of a stealth rate cutting regime. Have no doubt about it. The rate of change of the reduction of the Federal Reserve's balance sheet has slowed to a trickle. Now, here's a couple of problems. I staggered this out, good stuff, bad stuff. Usually I go with all good stuff or all bad stuff, and I segue to the opposite way. We're going to go back and forth a little bit here. So this is bullish. Net for equities. Horrible for inflation. Horrible for inflation, but good for equities. Schiller PE ratio. Equities are very, very expensive. Really, really expensive. 34 multiple versus a historical mean of 17.12. Now, the equity markets rallied today. What was the catalyst? Simple. Bad news is good news. You had a pop-up higher in initial jobless claims. Most of these initial jobless claims were found in New York, New Jersey, New York, California, Indiana, Illinois, the usual suspects of lefty states. And to be fair, Texas is up there too. So this is one of the proximate reasons as to why equities rallied today. And the minute that we saw this bad news, well, we took a look at the CME Fed Watch tool, and you saw an increase in the probability of an ease by the Federal Reserve going into September's meeting. And here you have the outcome of that announcement this morning. Gold, stocks, and bonds jump as bad news reignites rate cut hopes. It's sad, right? Bad news is good news for the stock market. So here's the odds of a rate cut. And you can see that in green, it really popped up higher. And that favors the September meeting. Yesterday, this was at around 67. This went up to over 68 this morning. Now we're back down to just shy of 68. This changes. Let's do a refresh. Yeah. So looks like we're solidifying September as a week where the Federal Reserve, a month where the Federal Reserve will be cutting rates. Now, this is not a sure bet. Next week, what happens, we get a lot of inflation data. We get the PPI, that's the producer price index, the level of inflation at the producer level. Then we get CPI, that's inflation at the consumer level. Retail sales coming out next week. A lot of data coming out next week that can adversely impact the probability of a Fed rate cut in September. So just be forewarned. Let's not get overly bullish on this market. Now, there's a day of reckoning coming up here. We have now an interest payment on our debt that is in excess of our defense budget. Our defense budget is over $800 billion. Our interest on our debt now is over $1 trillion a year. That's money that you're taxed at, and it just goes overseas or to pension funds, whoever owns our debt, and just goes into the ether. No road projects, no nothing like that. All the money going over to Ukraine, Israel, wherever they want to spend the money to get kickbacks here in Washington, D.C., that money gets printed and sent overseas. That's why you're seeing the interest payments ripped through the ceiling. So here we have the shocking stat of the day. U.S. net interest payments as a percentage of federal revenues are set to reach 34% by 2054. Think about that. 34% of our revenues will be going to interest payments by 2054. This means that 1/3 of all government revenue would be spent only to service the national debt. Over the past 8 years, the percentage has already doubled to 15% and is at the highest level in 3 decades. Meanwhile, nominal annualized interest payments have crossed above $1 trillion. I already mentioned that. We could see $1.6 trillion in annual interest expenses at the end of the year if the Fed leaves rates steady. Either way, if you're without assets, you're screwed. You're screwed. Why? Well, if you have assets, real estate, stocks, bonds, perhaps not bonds so much because we're in a bond bear market, maybe foreign bonds, but those assets will rise in value due to inflation. They will inflate. So at least your assets are keeping pace with your cost of living. And hopefully you have a good position, a good job, a good business, and you're able to raise prices or demand more of a salary each year and get paid more. Now, if you don't have assets and you're living paycheck to paycheck, then you're not making enough to keep up with the rate of inflation, and your assets, which are none, they're not helping you at all. You're out there by yourself, and it's sad. But unfortunately, they need to do this. They're going to cut interest rates at some point in time, and that is going to let loose the dogs of inflation on this economy. They're going to kill the dollar. I don't make it up. They're by virtue of the fact of their actions and the spending that they're doing, they have no other choice. Either cut rates and reduce the amount of interest that we're paying on our debt, or we offshore a tremendous amount of our revenues to offshore interest, and they continue spending anyway. So there is no talk of reform in Washington. The Uniparty is in charge. There is no Republican or Democratic Party. Forget that stuff. That's nonsense. It's a uniparty, and they do not have our interest at heart. So if you don't have assets, pay off your debt first. Think about then investing in real estate, whatever you can do. Just build up your portfolio to bulletproof. Become your own bank. Bulletproof yourself against inflation because it's going to get hot. They're making it that way. So we had the negative numbers come out today on initial jobless claims and what happened with the equity markets. Well, you saw the Dow Jones lead the charge higher today by over 0.75%. We're breaking out to new all-time highs in the Dow Jones. It's going up. These names are doing very, very well. In fact, today, for the first time in my long and distinguished career as a trader, I bought a call spread on Berkshire Hathaway B. The A shares just found out they don't have options on the A shares. I would have gone with the A shares, but I had to settle for the B shares. And we're already up on that trade. Looks like we are going up measurably higher. Our strike, we are in the money. It's 70% delta, 70 delta, not 70% delta, 70 delta. And we sold a insurance policy up at $430. So we make money up until $430. we cash out, we move on to the next trade. So I think that these mega companies, these Dow Jones companies, they are going up. We'll go to the charts of the triple Qs in a moment and the S&P 500. Why else might equities move up higher? Well, yield curve. We talk about this every single week, sometimes two. And we have a yield curve on the week that is down, bullish equities. Now, this morning, we started out the day with a steepening yield curve. And I said to members, listen, we need to watch out for this. Maybe it fades by the end of business, but maybe it doesn't. By the end of business, it did fade. Equities rallied, in particular, small caps and the Dow names. And it looks as though there's more fuel left in the tank. Now, back to the threats to the market. Here is a chart of the VIX. We'll go to my own version of the VIX in a moment, but this is a very accurate chart. This is what you call a descending wedge formation. For those not familiar with the VIX is, it generally trades inversely of the S&P 500. So we are in a descending wedge formation. We could break lower. I think on that break lower, we are going to get a massive reversal higher. So beware. It looks very, very bullish out there, but it's always bullish before the storm. This is a tell. This is telling you, buckle up, folks. Don't get too overly bullish on the equity markets yet. But in particular, those names that are now not outperformers, like Mag 7, not doing well, not doing great. Tesla, not doing good. NVIDIA down, SMCI down. But there are other names that are doing quite well. So, when it's bad? When you have two drunks trying to hold each other up. And this is a perfect example of something that we spoke about last week, about the yen, the reverse yen carry trade. I spoke about this last week. I won't repeat myself, but it's a very, very bad thing for U.S. equities. And this was posted last week on the 30th. Yellen is scared out of her effing mind about treasuries. Why? Because Japan owns a lot of our treasuries. We need them to buy those treasuries. Now, if they need to repatriate money back to Japan, that means they need to dump treasuries, and that will mute what the Federal Reserve is doing by not unloading a lot of debt. So it looks as though the BOJ and Treasury here in the United States are in heated talks to make sure that the Japanese do not sell and continue to buy our debt, as crazy as that sounds. Because we are over 125% to GDP in debt. The Japanese are over 200% debt to GDP. At some point in time, one of us is going to buckle. We're going to default. Just depends upon who. Now, what does this mean for yields? As long as the Japanese don't dump, the Fed stops dumping as much debt as they have been. You can't rely upon the Chinese to buy our debt anymore. We can see yields press lower in anticipation of a Federal Reserve cut. Now, what could stymie that? Next week's inflation data. I didn't say hello to anybody. So watch out next week for next week's inflation data. Let's say hello. Franklin, good afternoon. Thank you, sir. Appreciate that. Mr. Pete, welcome. Larry, can we trust Amazon today? I don't know. I'm kind of liking Amazon. Near all-time highs. I didn't look at it today. Maybe it's at an all-time high. We'll take a look, Larry. Trader Isaac, welcome. Sean, hello. Mr. Jeff, good evening. Gold and silver. I am still long GDX and silver. Good for you. Nice, Jeff. Yeah, we were long of gold, silver. Okay. Yeah, we love those names. Love them. Moving on. US dollar. This also lit a spark under the precious metal names today. Initially, the dollar was up, then flashed a bearish key reversal. So it is very, very safe right now to be long of gold, silver, platinum, palladium, oil. I don't care. Copper. We're going to go over copper in a moment. It looks as though we are heading lower here on the US dollar because the Federal Reserve is lining up to cut rates. That is dollar bearish. And this is why you're seeing the Dow Jones names lift up. Why would they be rallying on a weaker US dollar? It's simple. If the dollar is strong, our goods overseas are more expensive, right? Because our dollar is so strong relative to the euro, relative to the yen, the Canadian dollar, peso, whatever you're doing business in. Now, the Dow Jones Industrials, what do? They sell most of their goods overseas. So if they get a dollar that is weakening, well, that just helps their margins, doesn't it? It helps them with new sales because now their products are becoming more competitive overseas. So that's a good thing for the big Dow Jones exporting names, including the S&P 500 as well, by and large. Neil Kashkari, he said the secret part out loud. Fed's cash carry rates will stay high for an extended period of time and can't rule out a rate hike. So I think this is Neil, who's generally a bear on, not a bear, a dove on interest rates. I think he's just playing his role here. And clearly the Fed market participants who populate the Fed Watch tool did not take him seriously because clearly they are expecting a series of rate cuts this year. Now, here's the scary part. And it kind of reinforces what he's saying here. This makes sense from a logical perspective, from a Austrian economist view of how you manage your economy. Now, if you're a Keynesian who doesn't believe there's anything wrong with debt, well, then this is just off the wall shenanigans. This makes sense as a Austrian school of economics thinker, because if you have, this is out of the Federal Reserve of Atlanta, they're estimating a GDP growth rate of over 4% for Q2. Why are we getting that? Because of government spending. So it makes sense that you would expect a rate increase with a GDP of over 4%. Who ever heard of rate cuts with a GDP that's rising and above 4%? It's insane, especially when you're in an environment where inflation is taking off like a rocket ship. Here you have it. This is from Austin Goolsbee. This is a thug for the Uniparty, so-called economist. Inflation is slowing. Yeah. Cocoa prices. This is I think this is as of yesterday. Butter up. Potatoes, coffee, wheat, cheese, all going up. Cocoa is fairly off of its high, though. Labor costs. U.S. labor costs, and this is a good thing. We want to see labor get more pay, right? You keep up with the rate of inflation. Nothing wrong with that. U.S. labor costs spiked by the most since Q1 of 2023, according to the BLS, Bureau of Labor and Statistics. Unit labor costs soared in Q1 at an annualized rate of 4.7%, the biggest jump in a year. So you have an annualized rate of earnings growth at 4.7%. Yet you have an anticipated GDP growth rate of roughly what, 4.2%? So you have wages on an annualized basis outpacing GDP. That's no bueno. This was a substantially above average Wall Street. This is above 4% was expectation. I'll skip over my inability to read. Meanwhile, labor productivity slowed to 0.3%. So if you're getting increased productivity for your wage increases, well, then, okay, then the wages are keeping pace with productivity and you're making money. However, in this instance here, productivity slowed, yet wages went up higher. What does that do to margins at businesses? Crushes them. Higher labor costs will continue to be passed on to consumers as another major source of inflation. So, this is the reason why you need to have assets, gold, silver, real estate, stocks. If they go ahead with these rate cuts, the inflation is just going to take off. And honestly, the first rate cut is usually a top in the market. So I would favor commodities, real estate, and so on, rather than equities, until they cut enough where equities rally. This is incredible. So this is Suez Canal transit volume. Now, what does this mean? You have had the Red Sea. So you have the Suez Canal. You go through the Suez Canal, you float down through the Red Sea, and you enter the Indian Ocean or whatever ocean sea is there. And unfortunately, the Red Sea is kind of closed because you have pirates out of Yemen, and they're shooting missiles over at these ships, and we can't seem to get it under control. So the Houthi rebels. So what do they need to do? They need to take those ships, sail them down around the Cape of Good Hope, which is the southernmost portion of Africa, bypassing the Suez Canal. What does that do for prices of goods? Through the roof. Your shipping costs through the roof. How do we know this? We're looking at the Baltic Dry Sea Index. On the month, it's up over 28.5% on the month. This is the cost of shipping for dry bulk goods by ship. This is inflation. Yet they're going to, with a 4.2% GDP, a wage growth of 4.7%, they're going to cut rates. Absolutely insane. This is from Stanley Druckenmiller. Now, many of you know George Soros as the guy who broke the Bank of England. And he did. But his partner at the time was Stanley Druckenmiller. Now, Stanley is not a leftist whack like Soros is. He's a very logical, sensible guy. And this is from Stanley Druckenmiller. Stanley Druckenmiller thinks copper is a pretty simple story. Quote from Stanley Druckenmiller. Copper is a pretty simple story. It takes 12 years greenfield to produce copper. I guess it's a copper mine. And you got EVs, the grid, data centers, and believe it or not, munitions. These missiles all got enough copper in them, and the world's getting a lot hotter that we just think of supply and demand situation is incredible for the next 5 or 6 years. Ivanhoe Mines, Robert Ivanhoe said something very similar in a recent interview. So we're going to be looking at Ivanhoe Mines. We have two competing tribes. One tribe says, I want to save the world. I'm green. I need cobalt, nickel, platinum, palladium. The other tribe says, holy poop. The Army, Navy wants these metals for national defense. The intensity of the metal demand in conflict is beyond your wildest imagination. World War I, you needed a telescope to see through the price of copper. We're heading to a world where both tribes have strong enough demand for metals. We're balkanizing the world into two camps, and it's tearing the global supply chains apart. When two global goats start saying the same thing, it's time to listen. So here's a chart of copper. Boring copper. Boring. On the month, up nearly 14.5%. Folks, it's only the 9th. And we are breaking out of a major, major consolidation, and it looks like we're only going up. So a really fascinating story here in the world of commodities. I think that commodities is the new tech bubble, but in the early stages, we're nowhere near a bubble yet. You got to be in commodities. If you're not, you're making a mistake. Let's take a look at gold relative to the S&P 500. This is a ratio chart. On the week, gold is underperforming the S&P 500. The however is that this looks like it's setting up for a major reversal. Descending wedge formation. Let's take a look at the chart of gold. Here's gold, just up, ripping, up 1.62% on the month so far. Silver, up 7.5% on the month. The Federal Reserve, Treasury have all let loose the hounds of inflation, and they hate when these metals rally. They hate it because the dollar declines and they get humiliated. So, and if you want to take a look at a macro view of the mining space, take a look at this breakout. Monthly chart, the Dow Jones US Mining Index. A major, major multi-year breakout of a downtrend. So we were in and we still are in a secular bull market, but we went into a cyclical bear market. Now we are breaking out of it. It looks as though we are going up higher. Let's bring up Ivanhoe Mines. I believe that's publicly traded. It is. It's publicly traded in Toronto. Really? Not in the U.S.? They had the pink sheets here in the U.S. This is a copper play. This is extended. But look at this bull run. On the month, this pink sheet stock, Ivanhoe Mines, copper producer, up over 7.5%. Amazing in 9 days. Now, to be fair, this is extended. We're going to get a pullback in the next few weeks, I would assume. Lastly, we spoke about natural gas on, I believe it was Sunday, and I think I even went over it last week. Now, natural gas relative to the S&P 500 ratio chart up over 11.5% on the month relative to the S&P 500. Think about that. Here is UNG on the month, up over 17% in the past 9 days. We are breaking out on natural gas. I think the bottom is in. We've been talking about this. Now we're getting validation through price. Folks, it's a game on in the commodity space. Let's take a look at the weekly charts, and then we'll do some chart requests. We can skip over a bunch of these. Yields we went over. Bitcoin. I just had an alert fire off on Bitcoin a moment ago. Looks like we're going to break out on Bitcoin. Bond prices. I'm still not loving bond prices yet. This is a weekly chart. We have overhead supply in terms of price, and we have moving averages, which are actually going in the wrong direction. In red, you have the 20-period moving average. In blue, you have the 50-period moving average on a weekly time frame. You really don't want to see them go crossover. That's a negative divergence. So we need a big move in the bond market to avoid this negative convergence of the TLT, or yields could go press up higher. Tips. So this is the Treasury market, the tip market saying, hey, listen, Federal Reserve does not have our back. We thought they did. They pulled back for a few weeks in a row. Now, all of a sudden, they're concerned. They're concerned about their assets. They're going to go buy Treasury inflation-protected securities. That's why you're seeing them break out. The message is clear now. The Federal Reserve is saying, damn the torpedoes on inflation. They're going to go for it. 4% GDP rate, they're going to cut rates. The dollar. We went over the daily chart. We didn't go over the weekly chart. It's under pressure. If we close down on the week, that's a bearish key reversal bar. Up volume on the week is very, very light. Dollar under pressure. Euro. New weekly higher high, doing well. Yen. Inside week. No follow through from last week's bullish reversal bar. That was the BOJ intervention in the yen. VIX, we just spoke about this being in a descending wedge formation on a daily chart. Don't ignore it. This looks like it wants to go lower. We have one trading day left to go. There's nothing saying that we can't do a reversal. I doubt that we will do a reversal tomorrow. I think that we're probably going to trade up. However, because there's no news. There's really no news. No earnings, no news. So in all probability, we're going to close week here. If they drop us down to below 1250 on the VIX, you got to wonder, when is that daily reversal bar going to come and we get to rip your face off, sell off in equities? Right down here, support at around 12.3, 12.35 on the VIX. And that's pretty good support. So again, there are a lot of reasons to be bullish on the equity market, but there are reasons not to be. One of them is that stocks are very expensive, but we've overcome that in the past. Just go back to 2000. We were a lot more expensive back then. Here's your descending wedge formation. And technically, no, not really. All right, we're at the lower band of support. So I think we drop lower here. I think next week we get a big reversal day, just like we did on the 10-year yield. I mentioned this to members. We put on a trade. We bought SQQQ, bought a lot of it. And the reason was that the TNX, or the 10-year yield, was in a descending wedge formation, just very similar to the VIX. And I said, get ready. This is going to get resolved up. So we got pretty heavily short the Qs, and we got the pop up yesterday. Early in the morning, I took a good portion of that position off the table. We still have a decent amount of a position. Qs are laggards right now. So I'll probably reload. If the Qs get strong tomorrow, VIX drops down, I'm probably going to buy more of a short, getting ready for that reversal bar on the VIX. Then I dump all the shorts if we see any legs on the VIX. Excuse me. if we see the VIX reverse and move lower again and the S&P move up higher. I misspoke there. S&P's weekly chart up very close to new all-time record highs, no volume. This could be said for pretty much anything that's out there that's being traded. There's no volume. Qs up on the week, 1.27%, no volume. Let's check out the daily view of the Qs. Daily view of the Qs, and try that again. We broke down out of the wedge formation. That's the other reason why we shorted and covered a good portion of it. We're up at current. The problem is there's no volume. This is not institutional accumulation. This is mom and pop buying 100 shares of the Qs. These are shorts getting squeezed. Now, I did accidentally click on a 30-minute chart. It actually looks pretty bullish. So they may pop this tomorrow. Technology moving up over a percentage point, no volume. Semis up over a percentage point, broke out. They've broken out on the week. There's no volume. LABU, biotechs. They broke out on a weekly time frame. I happen to like this chart. We're down on the week, but what are we doing? We're doing a retest of a breakout point. We broke out of this descending wedge formation last week. This week, we're doing a retest of, let's call it $100 a share. Where do we close on the day? We closed down on the day. Don't I have another chart of LABU here? I guess not. Thought I did. Let's take our crayon out. You know, call it what you want. Call it a triangle formation. Call it a big bull flag setup. Call it a wedge. Call it cupcakes, donuts with no hole. It doesn't matter. Even though we've been trading down, this is a consolidation. We broke out last week. We're digesting those gains. Looks like we're going to get resolved to the upside. Consumer staples in Fuego. Very surprising. We own a ton of Altria, MO the symbol, and that thing has just been on fire. And it's paying us 9.25% dividend. So staples in Fuego, volume light. Let's bring up MO for a moment. The hell is that? Let's try that again. MO. So here you have it. Now it's only yielding 8.68%, up over 2.5% on the week. And it looks like it wants to go up higher. These are boring names. We saw these names setting up months ago when we were buying them. Some didn't work out. I bought Apache, bought BHP. BHP has its own issues I wasn't aware of. What did that do? What's that doing now? This stock should be ripping. It's starting to look good again. I may buy back in here. I may buy back in, but there's no volume. Discretionary names. Under laggards. Consumers dead. I would avoid this sector. There's no volume at all. Emerging markets. I'm surprised they're down on the week, but this includes China. Let's get rid of China. Still down. Energy. Breaking out on the week. Buckle up, folks. Volume, no bueno. Daily chart. Try it again, Bob. Daily chart. You could do it, fella. There we go. All right, so energy, a really, really good day today, up over 1.33%, and we are nearing an upper band of resistance. I'm not a buyer here. until such time as we break out above this daily resistance level. I think we're probably going to do it. Crude prices, bullish reversal bar on the week. Is this updated for today? Let's refresh this. Yes, it is. Up nearly 1.5% on the week. Boiled is our leverage product for nat gas. That's up 6.5%. Gasoline prices still down. Not much happening there. Gold we spoke about. Gold mining stocks ripping. GDXJ we own up over 7%. Nugget up over 11%. And breaking out. Silver. This is a leverage product up on the week. 13.75%. You just got to buy and hold, folks. Buy and hold. What lagged today? It's up on the week 2%, to be fair. But it was down. SMCI down over 2.75% on the day. NVIDIA is reporting earnings, I believe, on the 22nd. These stocks should be ripping right now. They're not. The banks ripping. We own Morgan Stanley. Morgan Stanley. I'm going to buy more. Wow, this is up over 2.5% today. Just rocketing. And the reason why we bought it is that you have a massive squeeze on Morgan Stanley on a monthly chart. On a monthly chart, Bob. There we go. Here you have it. We're just breaking out. The last couple of times that they've done this, Morgan Stanley has doubled. We're just breaking out now. We haven't even closed over $100 yet. So Morgan Stanley going up. So these are the names that are taking the leadership helm. So that's my shtick. I'm sticking to it. Let's do some chart requests and close this bad boy out. Okay. We go back to the members area. Sometimes they slip some in late. I think we did this one, BYOM, but I'll do it for Jeff anyway. Beyond Inc. Still not a buyer here. Monthly chart, we're down below support. If we close back above $20.75, I'd be okay with a buy here. We're not there yet. Month is still young. Maybe we'll rally back, but right now we've broken monthly support. I would avoid it. What else do we have out here? Franklin, did you have one? Oh, Larry did. Amazon. Amazon's going up. This is a monthly chart of Amazon. Major breakout. In fact, is this an all-time high? Yep. Clear blue skies. No overhead supply. Amazon. Looking good. We are at a monthly rising upper band of resistance. I'd be a put seller here all day long. Put seller. In fact, I may sell some puts tomorrow on Amazon. The only reason why I wouldn't be a buyer is I think that next week we're probably going to get a retest. Remember, we spoke about the VIX earlier and getting that rally, right? Because we're in that descending wedge formation. So if Amazon's at a weekly resistance level and we're anticipating a spike in the VIX, therefore pulling back many, if not all, S&P 500 names, then you should expect that Amazon pulls back as well. What's it going to do? In all probability, it's going to do a retest of this week's breakout point at 187.17. So I would probably be fairly aggressive with my put selling, maybe a 30 delta on the put selling. I'd probably make that a put spread, just so I have some insurance on that. but that's probably the way that we'll trade Amazon moving forward, and maybe even buy it next week on a retest of 187.17. If I'm right about the breakout, albeit however short term it may be on the VIX, it's going to be a relief rally come hell or high water. It's going to happen. So it's just a matter of how long does it last, that rally. So Amazon looking really, really good here. All-time highs, bullish. Michael, GTN, penny stocks? Come on. You're better than that. Best of breed. You got to buy best of breed. That being said, it's not a bad looking chart. It's a pretty nice looking chart, actually. It's been in the bear market. It is consolidating. It's stopped going down. We have resistance above at around $7.50, but it looks like this could move up higher. I don't know anything about the fundamentals. I don't buy penny stocks. Actually, I actually do. Gold money, I do. Gold money, which I've been holding forever. Bob, GDX monthly chart approaching long-term trend line going back to 2011. A break to the upside past this line would be huge. Yeah. So let's bring it up. So GDX, that's the senior miners. Now, this is a monthly chart, and I would argue that we have already broken out above that resistance level. We did it last month, but we faded. Now, if we take out last month's highs, we're coming up here to around $37 a share. There's going to be resistance up there, no doubt about it. But I think that with the volume that we're seeing here, we can break through it. Beautiful chart. So yeah, I'm very bullish on the gold mining stocks. Got to own them. Got to own them. On semiconductor, I don't know whether they've reported yet, so I would check that out. Weekly chart, it's a laggard. Not much going on here. I don't like laggards. Actually, I'm changing my tune here a little bit. We broke out last week. This week, a retest. You may get an upside. I think there's a trade to be had up to $80 a share, and I would be out of it because you have a lot of overhead supply there. I am a buyer here on a close above 71.30 per share. I'm a seller at $80 a share. SBUX. This is dead money to me. I mean, I was looking at this as an extreme oversold stock. It did not reach our price target. I wanted to buy it. It didn't happen. Maybe when it comes down to our price target, we'll be buyers. But the RSI is no longer oversold. Our edge is gone. This stock, I think, needs to go down into now with the pressure off, and you have that oversold condition resolved. I think that now you need to wait for the low 60s to go in and buy this stock as an investment. So to me, this is a dead cat bounce. Any weakness in the overall market, Starbucks is probably going to be the first to drop. Their products are expensive. They need to redesign all their stores. The consumer is dead. They're tapped. I haven't had Starbucks in about, I used to drink it all the time. I've been in Starbucks twice since they reported earnings. They're dead. The two stores I've gone into have been dead. Their products, there's really no product there except for the coffees. You know, I used to go in for the breakfast sandwiches, the egg with the thick bacon on it. It was actually pretty good. But their product line, they need a broader product line. So I'm not liking Starbucks here. I would avoid it. Too expensive. It was $3 for a grande, $3.20 for a grande coffee. Plus, they wanted me to tip the guy for getting me a coffee, making it what, a $4 coffee, which I did not pay the tip. So I'm not happy with Starbucks. I think they go lower. I would avoid this name. Did we do Sam for Pete? I forget. I don't think we did. Monthly chart. Interesting. I think you have a potential setup here for an oversold bounce on Sam Adams. The one thing I would be wary about by the end of the month is this. If we are still down below 286 per share, that's a problem for Sam Adams if we close the month down below that support level or now resistance level. So it looks like they may pop this, and I would sell that rip. So maybe they sent it up to its VWAP at 328. That's the trade here. I wouldn't stay long of it. I think that it looks weak. I would check out the fundamentals and look at their earnings report. If I don't know anything about their earnings report, simply as a technical trader here, I would be selling the rip up and into the VWAP, and I would exit stage right. Unless, of course, their fundamentals are turning around. Different story. Maybe it's an investment. You're welcome, Owen. Well, gold we already went over, Michael. Big bull on gold. FCX. FCX has been on a tear. I should have bought that versus BHP, but oh well. I think we're consolidating gains. I think this can only go up. I think that it's a very bullish space, and that Freeport-McMoRan is going to get resolved to the upside. I'm bullish on it. All it's doing right now is consolidating. I think this is the pullback that you're waiting for. You got to buy it here and hold on for dear life. I think it goes up. Last two. FSLR. Bullish. Oil prices rise. Solar stocks do well. This looks like it's about to break out. This is a daily chart, though. Let's go to a weekly view. Weekly view, a little bit extended. I still think we break out. Bullish on FSLR. And the last one is going to be Zim because I'm losing my voice. Woo! Wow. We were talking about this one a few weeks ago. This is a buy all day long. We're at resistance, so just beware. But this thing wants to go up. Wow, what a move. I think we rally up to 1752 before we get a pause. I think it goes up. All right, folks, that is it for tonight. Like, subscribe. You know the deal. Thank you for being here. Everybody have a profitable day tomorrow and an awesome weekend. Members, I will talk to you tomorrow morning. Be well.